Welcome to the Yorkshire Shadow MPC, a partnership between Recognition PR, Clive Owen LLP and the York Press. It feels like a lot's happened since our last meeting. Trump has applied, removed and reapplied tariffs in various forms to various countries and various industries. Average weekly earnings increased by 5.8% in April of 2025. That was outpacing inflation. However, job vacancies have decreased, and that indicates a cooling labour market. In April, the UK's GDP grew by 0.4%, a little bit better than people thought, and the rate of inflation remained steady at 2.6%, a little bit higher than the target. So we're here to talk about interest rates, what's happening with our biggest trading partners. Over in the US, the Fed held rates at 4.5%, while the Eurozone has cut its base rate by 0.25% to 2.4%. So what do businesses in Yorkshire think? And the Yorkshire Shadow MPC. Jonathan Doyle from Clive Owen LLP. What are your clients saying about the economy at the moment, Jonathan?
Well, I wish it was as sunny and positive as the weather this morning, but unfortunately the mood music speaking to clients at the moment is that it is quite tough out there, and there is definitely a subdued market. I think we've spoken at length ever since the budget about the impact of what that would do to businesses and their cost base. But the question that I ask clients at the moment is, what is their biggest challenge? And the vast majority of the time, what I'm hearing now is it's about consumer demand, and that's starting to flow through into how businesses are tracking against budget. Depending on what sector they're in, stories of competitors with some quite heavy discounting that's also having an impact. And I think that mood is reflected across some of the statistics that we see as well. So our institute provide a business confidence monitor, and for Q1 of 2025, it was actually negative for the first time since 2022. And in our region, in the Yorkshire and the Humber, we've seen a fourth consecutive fall in business confidence. I think that is also having an impact. You mentioned about the cooling of the employment market. We've seen the lowest employment growth in our region since Q2 of 2021. It's down at 0.6%. And I think the mood out there at the moment is a lot of businesses are trying to weather that storm, absorb those rising costs, because they know that consumer demand is quite fragile and don't want to push that on. But they're kind of stuck in a bit of a high burden when that comes to both financial and regulatory impact, but also the incentives are lower there.
Okay.
So yeah, R&D tax credits. There was a reduction in the rate last year, and that's now starting to flow into the numbers. So that's being predicted to slow to 1% in 2025.
Jonathan, that's extensive feedback. Let's have a little bit from Becky Hart of CBI Yorkshire. Becky, what are members saying in general about how they see the economy? What are you picking up?
It's a fairly similar picture. Obviously, members have been expressing concern about the impact of tariffs, whether that's direct impact or flowing through to higher inflation. Members are still concerned about what the Employment Rights Bill is going to look like. We know it's at the committee stage at the moment. And yes, we have seen business confidence drop sort of quite significantly, really, in the CBI growth indicator, which we published last week, and also investment intentions have dropped as well. Like Jonathan, I think we are expecting to see a bit of an uptick in consumer spending as wage increases flow through, but you know, it feels really quite challenging still for business. You know, they've done a lot of work to deleverage post-pandemic, but that isn't actually flowing through to investment at the moment.
Steve, at the York Press, you obviously published our Shadow MPC, but as a business, what are your advertising customers saying about where things are?
Fortunately, at the local level, the things that the tariffs don't sort of impact our customers. The nervousness of the national minimum wage and the other cost to staff costs has been concern. but on a local level, steady as she goes at the minute. There's not too much negativity going on, but there is some caution in the market, but not too bad. On a really local level, not too bad.
All right. Well, that's good. On my own business, I find that we've got the same numbers of clients, but they're not spending as much. In fact, I was a bit shocked at the end of April to have people asking for less spend when we got through April. But actually, when their pay bills had hit in April, they really took a view that they had to take some cost out. Dave Broadbent, now you work with Begbie's trainer. Well, what you obviously see quite a lot with your business, which is insolvency and specialist work, turnaround work. Are you having more?
Yeah, definitely. I think this is probably one of the first Shadow MPC talks we've said where I'm not the only miserable sort of speaker on there. Yeah, we're exceptionally busy at the moment. Numbers are up 50% on what they would normally be. We're certainly experiencing a number of small liquidations that we were back in 2018. Reasons, exactly what all the guys have said about cash. Cash is just it's a bit of a struggle at the moment. People are struggling to borrow monies. People are finding it hard to introduce capital themselves from their own personal positions. And small businesses are now getting squished from two ways. You've got, for most owner-managed businesses, one of their biggest outgoings will be staff. And of course, with the increase in minimum wage and obviously the national insurance side of things that kick in, those are taking the toll. And then we've got the old sleeping giant. The Revenue and Customs has decided to wake up, and the governments are now on a bit of an initiative to try and drag in this £60 billion of tax that they're owed. So a lot of our small liquidations are being driven by the man at the door being the Revenue and Customs coming to collect his taxes that haven't been paid for some time. And also just a general bit of sort of business fatigue out there. I think a lot of people have sort of battled for the last 4 or 5 years since COVID, and I think people are tired. And a couple of kicks that came out of the recent budget, unfortunately, pushing people over the edge.
Okay, Jordana Redshaw, let's talk about your business, Castle Employment. Are there vacancies out there? You heard my introduction saying that the job market had cooled. Is that your experience?
No, we're actually seeing an increase within Q1 of 2025. Job postings have increased by 13%, and therefore placements rising by 23% compared to the previous quarter. What we're seeing is a shift in candidate behaviour, though, therefore. So we've seen an influx and a significant increase in candidates looking for work, being more proactive, being more open to new opportunities, which is increasing that then competition for the positions that are available. Sectors, in terms of that are showing strength, we're seeing education, manufacturing, technology, healthcare, finance. So some sectors are really thriving, while seeing certain challenges, and others are unfortunately still, experiencing challenges as well as.
Well, I see your point there about candidate behaviour. I've just advertised a relatively small scale business, a job in my business, and we had 98 applicants, which is the highest I've ever had, which as an employer, that's a good thing, but it also indicates a weakness, I suppose, in the economy. Let's move to Richard Peake from Helmsley Group, developing different properties in hotspot of York. Richard, what do you think? Come on, lift us up, Richard. We're ready to be lifted.
I can't promise I'll have a go. I think on a few of these before, we've been sort of cautiously optimistic, and I think that's probably still the case. That we are still seeing a lot of buyer and investor just sort of wait and see, just see what's going on. People are pricing in 2 to 3 rate cuts during the year. It's just when those are going to happen. So whilst the start of the year actually was quite good, certainly at the bottom end of the market, I think those were mainly related to the stamp duty incentives that have now stopped. Prime areas and prime assets are still selling well. Secondary market and secondary stock is struggling, though. That is to be clear. We're seeing, for instance, good demand from a number of significant retailers wanting to have a presence back in York. The office market in general is sluggish on the owner-occupier side of things, but quite buoyant on the serviced office side of things. So companies spotting an opportunity to provide a sort of a more flexible serviced arrangement for companies. That's certainly something that we're seeing as a growth area. I'd like to see the rate cuts come pretty soon, if I'm honest with you. I think, but you've got to balance those against the sort of the general inflationary pressures that everybody's been talking about at the moment. But from my point of view on the property side, we're just seeing buyers just wait a little bit longer until they know where or when the interest rates are going to be cut on that side.
Okay, thank you very much, Richard. Last but not least, Matt Burgess. Matt, you're from Evelyn Group, advising people on their personal finances. What are you saying about how people are behaving with their own money?
Well, it's certainly created a period of uncertainty, and in the short-term markets don't like uncertainty. I mean, using the world stock market, for example, it's down 15% from its peak, and that's all come down to tariffs. By human nature, we try and time markets, but when we speak to clients, we've got to reiterate that long-term approach to when investing, because sharp falls like this have happened in the past, they'll happen in the future, and it's making sure that you can navigate the storm, go through it. But it's not all doom and gloom out there in the markets. The UK FTSE 100, so the largest 100 companies listed on the London Stock Exchange, is actually up year to date compared to the Americas, down 10%. Gold's at all-time highs, and the debt market, so government or corporate debt, is also producing positive returns. So whilst the US, which is the main stock market, it makes up about 70% of the world stock market out there, is low, actually not all asset classes are out there. So that really reiterates the importance of having a diversified portfolio to navigate these storms and go forward. I mean, going forward, we do expect the stock market to recover. To coin a footballing phrase, there's a lot of bounce back ability out there. Amazon, Microsoft announced results last week, fantastic results, but it's just uncertainty. Once we get clarity and looking at where valuations are now, we would expect the markets to be higher on a 12-month basis. Could interest rates cuts help stimulate that growth? Potentially and arguably, yes.
It was Warren Buffett that said in the short term, the stock market is an opinion machine, but in the long term, it's a weighing machine. So I suppose the results really do count. I actually saw that there'd been a little bit of an increase in the US stock market over the last 2 weeks. It felt like it was stabilizing a bit. Do you think that's just a bit of amateur observation, or is there something in that?
There is something in that. There's no doubt that it's been an overreaction, and the earnings that we're seeing from these businesses are actually beating estimates. And so actually there's good businesses out there. Let's use Apple. Results last week, very strong, but they don't know how these tariffs are going to affect them. They don't know how do they need to move production from China to India and the impact. They're just in discovery mode. And I think what was probably most interesting, we saw a 10% rise in one day about 2 weeks ago, just when they paused that 90 days. And so there's a lot of...
and America may have its first trade deal, and if it's with India, that could really set things off in a good way, couldn't it? Absolutely. All right, well, look, it's a snapshot of where we are. There's regulatory problems in the UK. There are tax problems in the UK. There are these international problems that you just alluded to. And yet there is an interest rate which has held. It's gone down a little bit. In America, it seems to be holding. And don't forget, there are people who are earning money from interest. Like Matt was saying, there are other forms of income. So what are we going to say? Are we going to go for hold, cut, or increase interest rates? So first, vote by show of hands. Who do you think wants to put up rates? Next, by show of hands, who wants to see a rate cut? Okay, my hand nearly didn't go on the screen there, actually. Next, who wants to see a rate hold? Okay, right, let's go round the table very quickly. One or two sentences. Why do you want to see what you want to see? Becky Hart, rate cut, why?
Just still seeing interest rates, although they dipped very slightly in March, we still expect them to peak in September around 3.3% inflation rates, beg your pardon. So we just see interest rate cutting gradually through the year as a way of trying to continue to stimulate a little bit of growth.
Okay, I'm next. My reason for a cut was actually a lot more has come out of the economy in the last 4 weeks, in my view, than people were expecting, and we need to make sure that our economy has a sufficient buoyancy to take us through. Jonathan, what's your reason?
I'd like to see a bit of a cut just to stimulate a bit more investment, particularly as there are pressures around cash and some of that absorption of those base costs from tax. So a cut to help for investment.
Dave, I think you were a hold person. What was your reason?
Yeah, I just think there's been a lot happening. I know what you were saying about the last 4 weeks, but I think there's just been quite a lot of volatility. And I think just holding it for now, see how the next couple of months go, and then take a view at the next quarter, I think.
Fair point. Jordana?
Yeah, I'd said no. I think that it would put further pressure on already tight budgets within businesses, which would make it harder for employees to retain or attract talent. And I think what we need at the moment is some stability, support to encourage that hiring and growth.
So you were a hold?
No, I was a no, not
you were a cut. You were a cut.
Yeah,
right,
yeah.
Okay, that's right. Okay,
Yeah.
Matt, you were a cut.
Yeah, as a cut, I believe that we need to help stimulate some economic growth. We're starting to see the slowdown out there, and a cut would be the reassurance that the economy, but also what the markets need for the UK at the moment.
Richard, it wasn't surprised to see you were cut. What was your cut?
Well, to be honest, if we're going to do the ratios, 52-48 in terms of going for the cut. It was we were just on the cusp. I think.
That's where I was. I agree.
I suppose it's either hold now and cut next time. But I personally, from a property perspective, a little bit of sort of supporting or is it improving buyer sentiment, just a little bit of confidence in the market as much as anything else, and try and get things moving.
And Steve, you were a hold.
I was a hold. I think, as Dave, there's been so much change. I'd hold now and cut next time.
Well, there we are. Thank you, everyone, for taking part in today's Yorkshire Shadow MPC.